sudden panic volume. Look at that sudden volume on the Qs. Talked about the Federal Reserve, talked about exactly what's going on in the economy, why this could be happening, what stocks are doing well, why is Tesla tanking, why did we see exactly this tank coming in the Meet Kevin Alpha report when yesterday morning we said, boys and girls, 579, don't get bullish on 500, the top's in, we're going back to 414. People thought I was crazy. Look at it, we're at 420, almost back at 414. Wow. Damn that Meet Kevin Alpha report. But what's going on? Is this just a temporary little volume panic, or what are the institutions reacting to? Well, Fed Myron, who's like the resident dove, and when I say resident dove, I mean he is the epitome of dove. A little bit of a softening of his stance this morning, talking about, oh, I might have to flip-flop if rental inflation comes up, which, going into this is actually a little problematic, because if you look at what's going on with shelter inflation and the trend we've been seeing, the trend has been down on rental inflation. But look at the last CPI read, rent of shelter. The last 3 months, 0.2, great. 0.2, great. Then 0.4. Oh no, what happened here? Oh no! Rent of shelter sneaking up a little bit, as well as lodging away from home, though that significantly less of an impact. What's a broad impact here is that owner's equivalent rent, you're making up about 26%, shelter in total, making up about 35% of CPI, 25% of PCE, Fed's in preferred level. But take a look at this, also a little bit of a rising gauge. And so we're gonna listen to Myron and see what he says here, because we don't really want that flip. And as a result, we've just got the 10-year treasury moving up about 1.5 basis points. Not great. But what is great is that we freaking nailed it. Double time today on the Meet Kevin Alpha report. Code Daddy's Back expiring today. Let me tell you what we said in the Alpha report the last 2 days. Expect institutions to sell off in the morning and then a slow slog up on the Qs, because the institutions go, oh my gosh, we didn't get unemployment claims data. I announced that right here, and it's exactly what happened. Slow slog up. Today, I'm like, we didn't get jobs data. Institutions might want to dump again, and then expect a slow slog after that. Literally exactly what happened. The last 2 days, I also said yesterday in the Course Member Live, people were like, Kevin, Tesla's going to go to 500, right? And I'm like, pre-market bump was your best chance of that. It's fully priced in now. Traders are going to exit. What's happened? Down 5% yesterday. Absolutely nailed it. Down 1.5% today. Absolutely nailed it. And so if you want to be part of that Meet Kevin membership, make sure you go get it at meetkevin.com. You've got that coupon code Daddy's Back expiring today. You get all 8 courses, could be tax deductible, every trade alert, every private live stream, every Alpha report. And you get all the new lectures that are coming out, in like our tax benefit lectures and our property management and otherwise. This is really great. So check that out over at meetkevin.com. Killed it again with the Alpha report. Like, knock on wood, man. We're on a great trend. I'm really excited about this. And the 2 stocks that we said medium term are really bullish, technical analysis wise, fundamental analysis wise, they're doing really well right now as well. Let's listen in over here though to Myron.
For joining us on this non-jobs day, we get no government primary economic data.
Dude.
Because
the only thing we got this morning were ISMs and PMIs. Which the ISMs and PMIs, just to like to get this out of the freaking way, because it just doesn't freaking matter, they were pretty benign, honestly. There wasn't really anything exciting in them. We did, though, see some warning that we might start seeing a sneak up in the inflation impact of tariffs at some companies. Like especially food importing companies. We saw restaurants complaining a little bit, but broadly we saw a little bit of a weakening of new orders and a little bit of softening in employment, since we're still in contraction on a lot of these surveys. We didn't get any kind of smoking gun to any direction, and broadly, if you look at the S&P report, the S&P report still indicates GDP growing at 2.4%, so not bad. For the quarter. Nothing really shocking out of those reports that are a replacement for the jobs data this morning.
Because of the shutdown right now. So let me start by asking, if that continues, As a member of the Open Market Committee, would you feel comfortable voting for a significant cut in interest rates if you don't have data on employment and on inflation?
Good morning, and thanks for having me. Look, I think it's important to recognize, first of all, that as you're pointing out, access to high-quality data is...
Love the tie, by the way. Love the tie. I'm surprised it's not purple. It's leaning a little left here, man, but it's a great color.
...is of utmost importance when making monetary policy decisions. However, it's also the case that we don't make monetary policy decisions every day, right? The FOMC meets to vote once every 6 weeks or so. Now, I think that's a bit longer than most shutdowns have historically lasted, so I'm hopeful that we'll get the data by the time we actually have to make the decision.
Well, despite what the president says, as you well know, inflation is rising. Food prices are up, gasoline prices higher than when he took office. Those are the prices that Americans notice and hate. So isn't it a risk to cut rates significantly in a regime where...
There is also the psychology. I'm telling you, I was just at, the best example I could give you about the psychology is I'm at the AT&T store dealing with some bullcrap customer service trash that I shouldn't have to be dealing with. Damn you, AT&T. I never have these issues with T-Mobile, Mint, or Verizon. Anyway, the gentleman was very nice. He's like, oh, I just bought a home. I just think it's, I hope rates come down. I just think it's weird. Inflation's still so high, but I guess they're talking about lowering interest rates. That was sort of his, as a human reaction. And I'm thinking to myself, oh man, that's exactly the inflation psychology problem that Jerome Powell has to fight. He has to fight this. Oh, look. Bloomberg's talking about
statistics in the entire world. To your point, Vishy, if we aren't going to have those, it's problematic. Jamie,
this is Goolsby talking about it's problematic if we're not going to have this data. So a lot of Fed speak coming out today. Obviously, Myron flipping on the Dove script a little bit. Less ideal. we want the Dove to continue being a Dove, please. Oops.
So my view is that policy should be forward-looking, right? I don't necessarily have a forecast that those items are going to continue rising. In fact, I think that a lot of them will actually reverse somewhat. But for my process, what matters most of all is the cost of housing, because that is the single largest component of the inflation process. And it's also one of the things that people notice the most. They notice when their rent surges. They notice when the cost of shelter increases. And that's why it gets the largest weight in the inflation indices. And my expectation is that we've just experienced, the biggest population shocks to both the upside and the downside in my lifetime, and I think in most people's lifetimes. And to me, it would be very surprising if that
That's a good point. I mean, you had a population shock to the upside with immigration, and then the downside with the reversal of that immigration.
Bring trace on the price of shelter, and so I am expecting a significant disinflation to the services component of the inflation indices driven by shelter, which is affected to an extent by changes in population.
Okay, so he is expecting shelter prices to continue to fall. Okay, hopefully.
Growth.
Well, we were talking before we came on about your view of R-star, the neutral rate.
And I should be clear, rent inflation to fall, which doesn't mean that rent prices fall. It just means they stop rising at a rapid pace.
We've got inflation running at basically 3%. You've got unemployment at 4.3%, which is historically very low. The Atlanta Fed says we're growing 3.8% or grew 3.8% in the third quarter. There's no economic model that I know of that would get you to a near zero neutral rate with those kind of conditions.
Yeah, so first of all, I have seen some folks argue that they think that my conception of the neutral rate is zero. That's not the case. I think that's a misreading of the speech. If you read the speech carefully, you'll notice that I do a weighted average of a model implied ex ante and a market implied ex ante rate, and it gets to about a half. And that's consistent with the dot that I put down on the statement, on the summary of economic projections. And so I basically thought, sort of going into things last year, there were all these policies that were pushing R-star higher, like the highest population growth we'd seen.
It's also worth remembering that it is true that gas prices, have gone up a bit, but and those are very, very visible. But really, how much of a component is that the Fed cares about? Less, because remember, we look at core so often, right? I'm just looking at some of your comments.
decades, the largest sustainable fiscal deficits we'd seen, sustained fiscal deficits we'd seen in a really long time. Those are pushing R-star higher. So last year I really thought it was at the top of the range of where everyone else in the committee thought it was, and I think it's now come down this year to the bottom end of the range of where everyone else thinks it is.
But you can't model that.
What do you mean I can't model that?
The models, if you put in the numbers that we have right now, it wouldn't spit out near zero or 0.5%.
Oh, real rate. Well, no, but what I've done is modeled my...
Yeah, people do this a lot. They get really confused between a real rate and like a neutral rate. Like, for example, there was another Fed speaker a couple days ago, and they're like, oh, I think, the neutral rate is 75 basis points. Like the real neutral rate is 75 basis points. And the idea there is the neutral rate is probably 2.75 because you add in the 2% inflation target. And then you add in the 75 premium, and then you get to a real neutral rate of just 75 bips. That confuses people. So when you hear that, keep that in mind a little bit. It's almost like designed to be confusing when we think of a neutral rate. And just looking at some other notes here really quickly, Myron does say that he has not yet had an interview for Fed chair. I'm actually surprised by that because I feel like he's actually a pretty solid, I think, intellectually sound economist. I thought he was frankly, just going to be like a Kevin Hassett shill, but he's pretty good. So, I like listening to him as a result of that. He says that, if shock pushes rents higher, I would adjust my inflation view. Then we've also got Goolsby seeing both sides of the Fed mandate deteriorating, but wary of front-loading interest rate cuts because the Fed data suggests the labor market is still stable. So that's interesting because it somewhat suggests, even though we're not getting the jobs data, the Fed's just going to sort of look through the lack of this jobs data and go, we'll just assume things are still stable, which is fine for now, until obviously poo hits the fan, and then the Fed will prove to be too late and prove Trump correct.
Expectations for inflation based on the changes that I see happening from housing, as we talked about a moment ago. I've modeled out changes to the output gap that I expect to see from policies that expand the supply side of the economy and therefore expand potential output faster than they would expand actual output. And some policies that we've seen enacted over the course of this year would push out potential and actual by the same amount or bring in potential and actual by the same amount. Other policies would push out one more than the other. And so for an example of one that would push out one more than the other would be deregulation, right? I think that the regulatory state has been being peeled back over the course of this year, and all indications are that will accelerate, particularly as the pace of confirmations of appointees has just picked up as well. That, in my mind, will accelerate the pace of deregulation too. And when you remove regulations, you expand the potential output of the economy faster than actual output. And so that
this is, in other words, a way to say that, hey, we could actually be supportive without necessarily just cuts, because we could potentially lean on what we're getting with deregulation a little bit. Interesting. I think there are a couple of other, bullish catalysts here. I think that's a little bit of like, okay, I would have loved a little bit more of a dove, but then again, there are things that apparently seem very bullish right now, such as investor sentiment. I mean, look, Goldman Sachs and their clients are the least bearish that they've been since Liberation, and they are the most bullish that they've been since the election. So you definitely have FOMO fever going on. In addition to that, I will say something that's very bullish is if we could actually strike a deal with China, game changer. China pushes Trump to drop curbs as it dangles investment. China is potentially dangling, as we're just now hearing reported by Bloomberg, the potential for a $1 trillion investment into America. Now, this is essentially the Chinese government printing money and throwing it into Train America and the American stock market, directed by Trump, essentially, which is brilliant because China just prints the money and who cares, and they get what they want. But I have to say, this would follow the model of Japan and other countries that are like, hey, man, if we can get a good deal on tariffs, can we just promise to invest a bunch of money into the United States? Because we'll make money on that anyway, because the U.S. goes up, basically. Absent obviously recession. Looks like China's also trying to push back on the U.S. stance on Taiwan, but this would be great Because right now we've got a lot of problems with our Chinese negotiations. I mean, I think China is, I've been saying this for a while, they're basically spreading the legs, going, hey, anybody who wants free trade, come to China. We'll manufacture all your stuff for you. They're smoking us on nuclear. I was talking about that a little bit earlier this morning. China's main competitor, or is the main competitor to the U.S. in innovation and deployment, and now they are a prolific investor, the most prolific investor in nuclear energy in the world. China fuels robotics with government spending and initiatives. They're fueling nuclear with government incentives and initiatives. They're basically, saying, hey, forget about Trump, come work with us. And they're killing it on their expansion. I mean, look at this. While we have the most nuclear capacity in the world right now, it's all from the 1970s, basically, and died at Chernobyl, basically. Look at this, nuclear capacity under construction. China, smoking the entire world. We have nothing under construction. So China, once again, dominating us. And so getting on the same page with China again, where they're destroying our soybean market, is so critical. This downtrend we called on the Alpha report continuing on Tesla. And the slow slog up continuing on the Qs. Both things we were looking at in the Alpha this morning. Not bad. But what I really want to focus on is, why is it that China's the last to make a deal? I think China is stubborn because I think they honestly benefit from Trump being a little bit of a bully. I think China benefits from that because it lets them go advertise themselves as, the stable people in the relationship of world trade. Who knows? But beyond that, there's like, if we're not going to have jobs data, which, this morning I'm looking, it's 5:30 a.m. I'm like, are we going to get jobs data? We're going to get jobs data. We're going to get No. Of course not. So it's like, all right, whatever. So absent data, I mean, we said the S&P services indicators and the ISM services this morning, not bad. Nothing really scary to report on either of those. And when it comes to the PMIs, we've actually got most sectors of the economy expanding. We brought Jack in this morning to read out that 6 out of 7 sectors were expanding this morning per the S&P. And again, the ISM's showing us going into a contraction a little bit here with weakness in business activity and continued weakness in employment. They still line us up for moderate or weak growth. Starting to see the impact of tariffs, construction's getting hit, AI demand continues to remain strong. That's where money's flowing. AI demand and financing around AI deals. That's where the money is going. No doubt about that. And then, again, U.S. services over here, still, GDP growing at an annualized rate of 2.5%. I think I said 2.4% earlier. So it's great. And yeah, the index is representing a slowdown from this peak that we had in July. And hiring activity is only increasing marginally. We're in like molasses in terms of most of the economy outside of AI, which isn't great that most of the economy is in molasses, but it's not falling off a cliff. And I think that's where Goolsby's probably right when he says, hey, our Fed data is indicating jobs data isn't coming off a cliff just yet. Now, the ADP numbers were absolute trash. It'd be nice to have the jobs data, but based on this, I don't know that 2 cuts are still a foregone conclusion until we actually get data here. And it explains why the treasury markets are as stable as they are right now, sitting at about 4.11 on the 10. Now, yes, you have this fear about like the economists pointing out, hey, credit markets look increasingly dangerous. And this has to do with private credit, how they're potentially masking dangers underneath because of financing receivables at like the Tricolor bankruptcy. But I mean, broadly, none of this is suggestive that private credit or the amount of debt in private markets is going to lead to some kind of 2008 recession. I think it's actually more likely that you have a labor market recession that eventually hits, and then those sectors will get, destroyed. You'll see a lot of pain in private credit. It'll really suck. But I don't think those are going to be the start of the disaster, so to speak. So we'll see. Then what else do we have here? Delays to UAE chip deal frustrate Jensen Huang. No, we want NVIDIA to keep going. So take a look at this. This I thought was an interesting column that's also worth paying attention to when we look at economic data. So you've got Greg over here writing an AI piece on behind jobs weakness are hints of a productivity revival. It's funny. I've actually got a whole, it's part of the Meet Kevin membership. I have a whole course on productivity, and people always wonder, like, Kevin, how are you so productive? You should see the new productivity lectures that we have queued up that are coming out, and they're going to be great. Remember, when you join the Meet Kevin membership, you get these extra lectures for free. So you get that lifetime access. You get that for those free extra lectures. So anyway, the economy is either booming or on the brink of recession. Honestly, you can make the case for either. Totally right. You really can. This is where I teeter. I'm like sort of in the middle here. You know, I'm in the 4s on the bear bull scale just because valuations are relatively euphoric. That doesn't mean I'm not buying. You know, I've got my list of top 10 stocks to buy for the next 10 years. We're on number 5, working on number 6 now. We've got near-term trades we're looking at. And I've also got a lot of like NVIDIA stock or whatever that I'm waiting to sell. But like, I don't really want to sell it now because it's like every day you wake up almost to make more money. Anyway, so what do they say here? There are possible explanations. First, consumption, investment, and trade data that goes into GDP for the past months might be wrong and could be revised. So this is something else that I talked about this morning, is this risk that you could see revisions to all this Atlanta Fed GDP, these readings or the data that we're getting. As we get data that gets reported down the road, which sometimes takes, waiting for tax filings, and it takes 3 to 6 to 12 months sometimes to get the data, you can see GDP get totally revised down. So all this enthusiasm that we have right now about the Atlanta Fed real GDP or whatever, we have to be careful. Just like we don't want to be overly pessimistic as with the numbers that we had that were negative for Q1, which we recognized was just a trade situation, and we were justifying and arguing that it's wrong, like this will be revised back up. We don't actually have negative 2% GDP, even though they made all the headlines. It's probably way too high right now at 3.8% because of the revisions that'll come. Anyway, that said, Bitcoin's rallying right now, 123.3, which is awesome. Let's see here. Second, the gap is anomalous and will probably close through slower GDP, more jobs, or both. And this is also true. This is what people are hoping for, is that hopefully we will have a soft landing in jobs. Here's a Renaissance macro researcher who says consumer spending has been driven by a drop in savings, and according to credit card data, has already softened. This is bad, and it kind of goes with the Challenger job cuts report that suggests retailers are hiring a lot less than they usually do, which is seasonally very odd. Usually, they don't see a drop in hiring. And the Challenger job cuts report showed some of the largest firing in retail for the last Challenger read for September. Third possibility is more interesting. A productivity boom might be in the works. This is, typically the bull argument that says, oh, well, everybody's so much more productive. You don't need as many people at jobs. I mean, I get that. We employ any cold task. This is my sort of quick productivity tangent. Any cold task you should use AI for. Any warm task you should not use AI for in the work. Any warm task would be like negotiating with a human or providing care for a human or empathy for a human. Stay away from the AI for these purposes because you're going to get more hallucinations. Creativity, I get it for like video and picture generation, but like business planning, things like that, you have to be careful because of the hallucinations. AI is really good at patterns and then commenting on patterns. So if it's seen something before, it can give you an answer. Historical fact checking of AI, great. Like quick Wikipedia resources, doing black and white things over and over again. These are cold temperature tasks, great. We do this a lot at HouseHack, and frankly, we don't need the staff that we used to. And I've been saying it for a while, like we could consolidate so much. And our, spoiler alert, like our numbers for Q4 and even coming up on Q1, even not even considering our Q1, are going to be amazing for like our P&Ls. That's my opinion so far on what I'm seeing. But part of it is because we are also becoming so much more efficient in our processes, and part of it is you have to give credit, at least to some part, to artificial intelligence. And I'm not even talking about the fact that we're running Blackwell chips for our artificial intelligence that we're going to release in Q4, Q1. The beta will be Q4 and then broader release, for Q1. But more just talking about even just consumer-related products that we could use. to be more productive with editing videos or posting videos or workflows with business or accounting, reconciling. Intuit, by the way, they are, I think, like a hidden play for artificial intelligence, because now they're offering AI to help you figure out why your stupid bank account won't reconcile. Anybody who's ever reconciled a bank account in QuickBooks knows it is the worst part of accounting. And now they'll sell you AI upgrades to do it for you, to tell you where maybe there's an oopsie doopsies. Dude, I've spent hundreds of hours trying to figure out where my stupid reconciliation errors are, over my career. It's a pain in the ass. Now AI can help you do it in a fraction of the time. It's amazing. So, but do keep in mind, GDP gets revised many times. Not only do you get, after your initial release, you get 2 other releases. You could even go in the past and revise some data, like as much as a year back, looking at just some of your numbers here. But yes, consumer spending data has really been aligning with the decline in savings. Eventually you hit the floor. So, an interesting piece so far. Increased output with no increase in hours means output per hour or labor productivity grew at 3.5% at an annualized pace, which is actually, that's very good. Because of the divergence between GDP and employment, and this divergence won't likely be sustained, neither will productivity performance. Even so, including third quarter estimate, productivity has grown 2% annualized for 2 years now. That's a decent pickup from the 1 to 1.5 we've had before. That's bullish. That's fantastic, as long as you don't get layoffs. Something very likely has to do with technology. One candidate is generative AI embodied in LLMs, GPT. Okay, adoption has been remarkably fast. Walmart recently said it would keep unemployment flat for the next few years as AI literally transforms every job. I don't know that it transforms every job. I think of it as augments almost every job. Even in construction, you go to Lowe's and you're like, oh man, should I use the Santee or should I use the Y for my sink drain? Oh, you should use a sanitary tee. Okay, great. Like little things like that. If you're like a newer plumber or a newer electrician or whatever, it's fantastic because it's just black and white. It's easy and just gives you those resources right there in your face. It's fantastic. So very, very excited about how AI could even affect the non-AI businesses. I mean, I was with all my fans yesterday, and I really appreciate all of my fans. But I was grateful because I didn't have to load up all my fans. I had full self-loading, loading up all my fans. This was Jack and I yesterday. We were negotiating with the manager of Lowe's. Shout out to the manager of Lowe's over there. But it was amazing because I was using my pro membership, and like what would have in the store been like $2,800, my pro membership got to $2,300, and then I negotiated with the manager, and they took it down to $2,100. And I'm like, let's go. This is all house hack, by the way. Jack was loading it all up for me. Be careful, by the way, if you load the tonneau too much over here, it'll get jammed. And so ours got jammed, so I have to be careful about that. But yeah, dude, we got a lot of house hack renovations going on right now. It's fun. I love this. So this was us at 10 p.m. yesterday. 10 p.m. yesterday. I got to show you this clip of Jack. He's this poor guy. We were dealing with a fixer-upper, and I think we've primed this floor now probably like 3 times or so. Beam this over here. But anyway, we've got a concrete floor that at some point, we've already chemically treated and to deal with some cat urine issues, and it's like a pain to deal with. But so we treat it. They're actually technically not more natural products. You don't want to use certain chemicals. Anyway, long story short, we go treat this floor, and we use some expensive primer on it, multiple coats, and finally, it's smelling better. It's actually, you can't even tell anymore. It's great. I was there at like 10 p.m. yesterday. I'm like, this is fantastic. We've solved the problem. But this is the stuff that we do, for house hack, and I love it. I mean, it's my job. I'm the CEO, right? So I'm a little biased, but we think we're contributing to the economy. This is Jack. I make him carry it. I gotta put him to work. I tell him I pay him, so I put him to work. But anyway, this is the floor. It's just concrete, right? And he's got his flashlight on his watch. And he actually ends up saying like, oh, it smells better in here. Actually, I think you could probably hear him say that.
Is this the cat he's smelling up?
Yeah.
It smells better.
Good. It smells better. I love the guy. Great worker. I pay him. You know, but you got to put him to work. So anyway, so that's pretty fun. But anyway, you know, going on with this productivity thing, like I see it, like the productivity all the time, and there's so many tools that we could use in artificial intelligence. It's really, really fun. So really big fans of this. You know, as you saw, I had a truck full of fans. But anyway, take a look at this. One widely cited report by NANDA, an AI initiative at MIT, found that 95% of 52 organizations surveyed had zero return on their AI investments. This suggests AI has yet to make enough impact for the economy's aggregate productivity to move. Right, so you're seeing it on the individual level, but like, are you able to like put the dollars on it? A lot harder. You know, this makes sense because a lot of these are like Wikipedia wrappers, basically. That's what I call them, chatbot wrappers. Like, it's very rare that you're seeing real artificial intelligence products. My opinion, I'm biased. Don't sue me, bro. Investments can go down in value. There's risk with every investment. Full disclaimer, nothing in this video is personalized financial advice. But like what we're doing with our House Hack AI, for example, is we want to enable agents to be able to, and consumers, to rank the best real estate deals available at any market at any given time. So rather than you looking at, you know, 100 or 200 new listings every day, you just open up the House Hack AI, you pay us a few $100 a month or whatever, and it automatically, with your branding, sends to your clients the best deals in a market using Kevin's analysis fueled by AI. In other words, like I train the AI and the AI does this for you automatically in your market. You know, we think that is actually productive. No more clients calling you going, yo, why didn't you send me this deal, right? That is a form of efficiency. That's huge, you know, and yeah, like, we don't know. Maybe people won't buy it, right? Like maybe people won't be interested in it. I don't know. That's why I have to, you know, sort of limit some of my optimism. But I look at it and I'm like, you know, if that takes off, it's a game changer for revenue for House Hack. But you know, we'll probably, I mean, if it does really well, we'll end our Reg A round, which is at househack.com. You could invest, you get 5% per year through conversion, 100% of the upside in the stock. And really the valuation of the company it's at the low end of its Wall Street valuation because we want to give a good deal to our subscribers and fans. But we think that, you know, if venture capitalists see the AI that we're doing, this round's going to close like yesterday. So we're pretty excited about this once we release it. But we don't have any VCs because, you know, it's just so far we've only been selling this as just a real estate buy and hodl company. And the fact that we have this AI cooking is really exciting, but it also gives me, in my opinion, so much insight into what's going on with productivity, because I don't just use AI as much as possible as a CEO, as a business owner, as a YouTuber, in real estate. I see it in construction, I see it in all these different levels, but then we're also developing. You know, so we see the demand for chips and GPUs. This is why I haven't sold the millions of dollars I have in NVIDIA yet. I can't wait to, because I'm nervous, because I think, you know, the market's a little frothy, but I also see why they have such large PP right now.
Big PP.
So LLMs are building on existing investments in e-commerce, software, big data, cloud computing, machine learning. Recent analysis by Goldman found that the pickup in productivity has been concentrated in technology. Yeah, totally. In related sectors such as research, engineering, and consulting. It's also more evident amongst the fast-growing superstar companies. While it's premature to ascribe all of the acceleration to AI, industries have some of the strongest use cases for AIs. Well, certainly like logistics, right? Oracle, I'm nervous about the Oracle debt bubble. I actually love that Amazon is financing less of their expansion, whereas Oracle is using a lot of debt. You know, I personally don't like using a lot of debt. You know, I personally, for example, like I just paid off my house because I'm like, I don't want to go into a recession if there's, you know, if we go into a debt situation. If we go into a recession, I'd rather have my house paid off and use that as a piggy bank. I treat House Hack the same way. Like I put my money where my mouth is. House Hack has very little debt. It's bond debt that's convertible. And, you know, we've got over probably around $64 million in assets, cash and real estate. That has no debt at all, no bank debt, nothing. The company overall, somewhere knocking on the door of 80 million in assets. These are rough ballparks off the top of my head. And, I think that's why we raised over $1 million in August. I think we crossed $1 million in September. I think we raised like $80,000 yesterday alone. Because people are like, yeah, here's a low debt company. That is an opportunity to diversify from like an Oracle, which is just like, take on more debt, take on more debt, take on more debt. It's crazy. It's scary to me. The amount, like, I posted a short on TikTok where I'm like, realize that the biggest risk is assuming you can refinance. Because people think that, if I just go into debt right now at 6.5%, I could always refinance if there's a recession. But what happens if the lending standards change, if the banks are nervous to lend, or you can't get an appraisal? You're screwed. You don't want to get screwed, Bubbles can generate genuine productivity benefits. True, I mean, Jeff Bezos, I guess this morning, he's like, oh yeah, AI is a bubble, but it's a bubble that's going to have productivity. Okay. All right, that's an interesting line. Remember the Alamo, by the way. It's my Alamo mug today. I'm actually also wearing an Alamo sweater. Alamo sweater and mug today. We're full Alamo today. All right, what else here? Certainly true of the internet boom. First 5 years of the boom. Annual internet-related investment rose by 1.25% of GDP. Wow. Yeah, most of GDP growth. Annual productivity averaged 2.9%, double the rate of the past 2 decades. That's exciting. And that rate per capita income doubles in 24 instead of 47 years. Wow. Productivity is a good thing. It just helps everyone, raises the standard of living for everyone. Citi estimates that annual spending on AI equipment has risen by 0.9% of GDP, a bigger surge than the equivalent period of the 1995 to 2004 boom. Wow, even more of look at that. Investment in AI overlaid. Yikes. Yeah, it's a bubble. Several academics have estimated AI's boost to productivity by measuring how many tasks AI could automate and the resulting cost savings. Citi concludes from those estimates that AI could raise productivity by 0.5 to 1.5 percentage points, less than the internet, except in the most bullish scenario. That would boost growth, but push downward pressure on inflation. Yes, that's also true. Shift towards deglobalization will reverse earlier disinflation. Yeah, but we will re-globalize. We'll go back to globalization. So, yeah, I mean, like, I do think there are very valid arguments around productivity. The only thing we don't want is a normalization of the beverage curve. That's the only downside to this economy right now. If we could verify that we are not going to normalize the beverage curve, which is, going to be fueled by large layoffs, where our unemployment rate skyrockets to, 10%. As long as that doesn't happen, we're good. Like, there just aren't that many negative catalysts. It's just that. And that's why it's such a pisser that today we don't get the data. Oh, damn. Our one of our medium-term trades right now is up 4.5%. That's on top of the percentage gains it's already had over the last couple of days that we've been talking about one of these medium-term trades. Sweet, let's go. Tesla's still down 1.9. And Qs are still slogging. Slow slogging away. The slow slog. Yeah, you just... not that much bad data because Trump's hiding it all, which then also makes you wonder, like, does Trump kind of want this shutdown to keep going on? Well, partly, yeah, because it's allowing Russ Vote to go crazy. I wrote down some notes on Vote. Vote is the chief author behind Project 2025. He basically wants to cut everything except Social Security and Medicare, because those are entitlement programs that are huge with the Republican base. Like, actually any base. Anyone who says they're going to cut those programs loses elections because those are people who actually vote. Then you've got, we know he's super anti-Department of Education, housing. He hates the food assistance programs. You've got, recently yesterday we saw the big cuts, $8 billion in the green energy programs to blue states. It was all blue state governors. And we also saw him destroy 90% of the Consumer Financial Protection Bureau, which is your Dodd-Frank ability to repay agency, which is scary because in my opinion, I don't think we're in a housing bubble because we've had such stable housing loans for the past 15 years, especially because of Dodd-Frank ability to repay. If you've ever taken like a lending test or whatever, you'll know about that. But this could actually unlock even more crazy creative financing to where if we don't have an employment bubble pop, then we end up with crazy, arcane loan terms that allow people to get into real estate with terms that'll be really, really bad in a recession. Mind you, I also tweeted, and I totally agree with this. I'm agreeing with myself here. But I totally think this is valid, and I just want to reiterate it and highlight it. I think one of the best jobs, if you were looking for a job right now, one of the best things to potentially get into is the lending industry. So if you could right now get a real estate license and then get your MLO endorsement, your mortgage loan originator endorsement, best combo for the next 10 years. Because if we go into a jobs recession, you're going to have a lending boom. If we go into a soft landing, you'll have a lending boom that's more creative financing, probably. But you also have a real estate boom again. So real estate and lending, I think if you got in now, you'd be getting in at the bottom for that. So very, very interested in that. So we'll see. Very, very exciting. But yeah, otherwise, again, like a monkey see no evil, monkey hear no evil. We got good things going on, and the AI productivity is awesome. I mean, if you didn't see it, I posted this yesterday. This was a 32-second clip entirely edited by AI, like all of it. The music they put over this icon, the children, well, the children aren't AI, but the angles. It was a 360-degree camera. It's the Insta360, and it's just, I push a button in the app. See, Ella's holding the camera, so I'll give the kids the camera. Ella's holding the camera, and basically, like, it's like a 4-minute recording. I press AI record, and it does the whole 30-second clip. I'm like, this is great. This is fantastic. I can then post that on our family share. Because we have like an Apple Photos family share where we have like half-breath kids. And so that way, like, our in-laws or parents or, friends or whatever, they can post photos of the children in that category, so that way it's always consolidated there, and we can always just look at pictures of the kids there, and we think it's really, and the kids love looking at pictures of the other kids as well. They get exceptionally happy about that, which I think is like the sweetest thing in the world. I had Jack yesterday as I was getting ready to take him to dinner before we went to go do our sort of midnight fan work. I took him in the car, and I showed him that video clip. And it was so cute seeing his face because he loves looking at pictures of the kids. And I took this photo with my Meta glasses. Here he is. You can see how excited he is there. So that's really always nice to see. Happy children. And then I think after that, we went to Wood Ranch, and I had a ton of bread rolls. I had way too many bread rolls, man. It's the problem with going to Wood Ranch. Oh, it's the death of me. But let me see here. So I also looked up the NIT Sloan Management Review report, found only 5% of surveyed organizations achieved significant financial benefits from AI, meaning 95% achieved little return. You're not going to see it for a while. It's hard to like quantify this. It's going to take time for people to really actually see this, in my opinion. China concludes AI raises productivity, and so does Citi. Yeah, well, we know that. So anyway, very exciting. Very exciting. So we'll see. We'll see what happens. But otherwise, there's nothing in the data right now that suggests bearishness. And that's probably in part, obviously, we called the buy the rumor, sell the news on Tesla. This was not a surprise. But that's also not even bearish Tesla. That's just sort of like, that's called trader momentum. So I know people, like I saw a bunch of people leaving comments like, God, why is Tesla down? I'm like, well, apparently you didn't read the alpha report or you're not a member. But that's okay. But I think that's one of the reasons why you're also right now seeing some of that nice push in Bitcoin and Ethereum, which is really taking, babies are back in, which is really taking off right now. We're going parabolic over here in just the last hour. And it's awesome. But it's really, in my opinion, because, well, probably Michael Saylor's buying. But there's just a lack of a downside catalyst right now. So, anywho, good news is you can still use coupon code Daddy'sBack at MeetKevin.com.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.